Okay, so let's go straight to Market Street and get a sense of how the latest higher inflation reading, 11.37% year-on-year from 11.25%, and a stronger 0.94% from 0.79% in the month of March. Take it straight now to the CEO at AfriInvest Securities. Let's get a sense of both the equities and the fixed income space, what to expect from today. Ayodeji Ebo is the CEO there and is joining us via Skype. It's a very busy day for everyone down there, so we appreciate that. Ayodeji, good morning. This is how the numbers are hitting your Market Street. So bring us up to speed. What's your understanding of these numbers?
Yeah, good morning, Wasim. Thanks for having me. The inflation rates moved higher, like you mentioned, 11.37%. But we're also trying to look at its implication on our market. We feel that starting from the equities market, beyond the inflation rate, we feel that the variable or the factor really affecting our markets in terms of affecting the sentiment is more macro, more structural issues. And you look at in terms of the mix of the equities market in terms of transaction, the foreign investor plays a major role. So it's like a 50-50 market share that the foreign investors have. So in terms of looking at how inflation would impact, investors, especially for the equity investors, will look beyond the rising inflation that we expect continue within the next 3 months due to the planting season. We look beyond inflation. And for the fixed income investors, yields are still currently higher than the inflation rates. Average yield in the treasury bills market is around 13% levels. And also in the bond market is also between the 13.5 and 14% levels. So that still leaves some form of headroom for positive return for investors. So by and large, trying to tie in terms of the impact of the inflation figures that have just been published to the performance of the capital market, we have other issues, other factors that needs to be addressed before we can see, especially for the equities market, any major rebound in the equities market.
Okay, so if we're looking at this inflation reading, you said on the fiscal side, so I look at treasuries still about 12%. Yes, that is good. But again, it looks like the gap is closing. The central bank at the last MPC hinted that we could see inflation moving through from May till August. If this go a little bit up to that level around the current pricing or the yield curve for treasuries, do you think it's likely that investors will be asking the central bank, the debt management office, for a bit of a higher yield on those Naira papers that we will keep rolling out? Do you think it's time yet, or everybody still think everything is fine? So let's discount this inflation. Let's just ignore it, at least for the moment. How much longer do you think they will be able to ignore trading inflation, higher inflation by market traders?
Yes, you are right in terms of the gap thinning out. But when you also look at in terms of the other factors, the demand, we've seen increasing demand from the foreign investors with the reappointment of the CBN governor for a second term. You would, based on the policy that the governor pursued in terms of FX stability in the first term, for most of the foreign investors, they are a bit in terms of guaranteed a bit in terms of the exchange rate direction. So we've seen more influx of foreign investors keying into the fixed income market. As a result, if we noticed last week, the OMO rate dropped slightly as a result of the increasing demand from the foreign investors. And this week, yields have also moderated, especially within the short to medium spectrum of the fixed income market. So though the investors would have loved to ask for more return, but as a result of the funds chasing, when you have too much money chasing the few instruments that we have, yields will drop. But we don't expect yield to drop significantly below this current level. They may drop maybe maximum of around 100 100 basis points, which we feel that as government also tries to fund its budget, Mr. Bismarck Ruhani spoke about the supplementary budget earlier in this on this program. That would require government to also borrow more to fund the budget. As a result, for government to be able to fund that budget, for investors to be able to part away with their funds, then they would request for more higher return. So in the medium term or the short to medium term, yields may drop. However, we expect that that would increase even as we move towards the end of the year because of the need for government to borrow.
There's a need for government to borrow, but again, well said. I'm sure the fixed income guys will be take this in their stride. But then for equities, and I go back to that to wrap up this conversation with you, Ayodeji, which is very important. You said that the equity side of the market street of the capital market needs its own stimulus, as it were, that catalyst. Where do you see that coming from? The market, the stock market has been taking the GDP, the inflation on the chin, just trying to find a way to keep trudging on. So, do you think inflation will continue to be a play? Will it be the next MPC? Will it be the first quarter GDP numbers? What will stimulate companies, traders, investors, portfolio and otherwise, long-term, short-term, to say, look, I think we've given this market, stock market, enough beating. It is time to reward the market?
Yes, thanks for that question. Looking at what catalyst that would move the market, if I hear you clearly, we expect that once after the inauguration, some of the major policy in terms of private-led policy that will shape direction. We need to, foreign investors or investors need to see that the government would work significantly or closely with private investors. Because when we look at the budget, government contributes less than 10% to the overall GDP. The private consumption, how do you want to grow that? Investment is also very key. So if we don't see some of these factors, we doubt that there will be any major lift in the market. Yes, a lot of investors are also trying to anticipate in terms of the quality of the cabinet that will be announced after the inauguration. It will play a major key role, especially for some major position. The Minister for Finance must be someone in terms of someone very respected, knowledgeable about the economy, both that will be able to synergize the impact between the monetary policy as well as the fiscal policy that will be able to bring both parties together. That's some of the major areas that the potential equity investors will be looking at before we can see any improvement in sentiment. Because if you analyze, looking at the results of Q1 results of most of the companies that are quoted, besides the banking sector that seems to have recorded positive growth, most of the other companies within that space are really struggling. The consumer goods are struggling. The industrial goods are also struggling because of cost of business keeps increasing. And because of the consumer spending that is being pressured, the ability to increase or pass that cost to the consumer, that it is reducing. As a result, margins are thinning out and most of those companies are just struggling. So if we don't look at policies that will drive and reduce cost of business for most of these companies, investors in terms of expectation of positive return would wane, and as a result, buying interest may also be impacted.
Ayodeji Ebo, the CEO at Afrinvest Securities. Thank you so much for your time today, a chartered stockbroker and a member of the stock market. Thank you so much. Do have a great day. We appreciate your time.